The price of crude oil just surged by 64% from $70 to $115. This is the biggest weekly gain in oil futures history since 1983. And it was all thanks to the US and Israel going to war with Iran. And in retaliation, Iran closed the Strait of Hormuz. This has a huge impact because 20% of the entire world's oil supply flows through this strait. And without it, this might be one of the biggest oil supply shocks since the 1973 oil embargo, during which the inflation doubled and the S&P 500 fell by 40%. And here's the thing, every single oil price shock in the last 50 years was followed by a recession. So the question is, are we about to watch it happen again? In this video, I'm going to walk through what historically happens to stock markets when inflation and oil prices spike like this, and more importantly, what it actually means for us as Singaporean investors. Let's not waste any time and let's jump right in. So we are now on day 9 of this conflict and things are escalating fast. The strikes are now hitting oil infrastructure directly, including the Sharon oil depot near Tehran, which is currently on fire. Meanwhile, the Iran military has prohibited vessel passage through the Strait of Hormuz, warning that it would target any US or Israeli ships attempting to pass through. And in turn, Kuwait has now halted oil exports as of March 7, cutting 2.6 million barrels per day of production because tankers simply cannot transit the Gulf anymore. The UAE is also cutting output. Saudi Arabia may follow soon. Meanwhile, Qatar's energy minister has also warned that all Gulf states will shut down exports within weeks if this conflict continues, putting $150 oil on the table as a 2 to 3 week scenario. Qatar's Ras Laffan, the world's largest liquefied natural gas terminal, has already halted all exports after a drone attack, and it won't restart until there is a complete cessation of hostilities. But even then, it will take weeks to months to come back online. So right now, there's no sign of this conflict de-escalating. On March 8, Mojtaba Khamenei, the son of the killed Ayatollah, was named the new supreme leader of Iran. And Iran has vowed to continue fighting for the sake of their people. On the other side, Trump is not backing down either, and is now demanding unconditional surrender. All of a sudden, the US original 4-week plan is looking more and more unlikely by the day. As for the markets, well, the S&P 500 had just saw its worst week since October. South Korea's Kospi triggered a circuit breaker after an 8% crash, while Bangkok's SET index tumbled 8% and also triggered a trading halt. I guess after so many months of winning, we were overdue for some red light therapy. Now, if you want to start investing, you need to keep your costs low. That's why I use Interactive Brokers. With Interactive Brokers, you are paying just 35 cents per trade on the US stock market. That's one of the lowest in the industry. They also give you access to Ireland domiciled ETFs, which can save you a chunk of dividend withholding taxes. And if you are not sure what to invest in, they also have a bunch of free company research tools built right into the platform, so you can do your homework before putting your hard-earned money in. Check out my link in the description to get started. Alright, now back to the video. But to understand how bad things could really get, I put the S&P 500 returns after every major oil shock in the last 50 years and put them all into one table. Check this out. On day 1, the market actually drops in most cases, but by the first week, it tends to bounce. 4 out of 5 times, the market was actually higher after the first week. Then, by the 1 month mark, the median return dropped back down to negative 0.7%, with 3 out of 5 shocks in the red. At the 6 month mark, it gets even worse, with the median return being negative 5.4%, and the average reaching as far as negative 9.7%. And at the 12-month mark, the median return goes even lower to negative 7.4%, with only 2 out of 5 shocks ending in the green. Now, there are 2 key takeaways from this data. First, the oil shocks in 1973 and 2008 were the worst by far, and that's because oil prices stayed elevated for months in those 2 periods, not just weeks. In 1973, OPEC kept the embargo going for 6 months, and in 2008, oil was above $100 for over a year. Second, the shocks that resolved quickly actually recovered. 1990 is the best example of this. When Iraq invaded Kuwait, oil prices doubled overnight and the market fell by 8.1% in the first month. But once Operation Desert Storm launched and it became clear that the war would be short, the S&P 500 was up by 10.2% within 12 months. 2022 was similar. When the Ukraine invasion first started, oil spiked to $130, but came back down relatively fast. So the key pattern is this. It's not the spike itself that causes the damage, but rather it's how long the spike lasts. Short spikes led to fast recoveries, while prolonged spikes will lead to deep recessions. So now we know the pattern. But what does $115 oil actually mean? Oil doesn't just affect petrol prices, it flows through to everything. So let me break it down by each scenario. At $115, which is where we are right now, 95 octane petrol in Singapore has already climbed from about $2.80 to $3.05 per litre. Global shipping costs are up by 18% since the conflict started. Singapore's core inflation was just 1% in January. But with oil up 64%, inflation could easily re-accelerate past 2 or even 3%. And the Fed, which was expected to cut rates this year, is now likely to hold rates or even hike it further. Then if oil hits $130, things will get significantly worse. Petrol could hit $3.35 to $3.50 per litre, which is a 20 to 25% increase from pre-conflict levels. Airlines will start adding fuel surcharges, grocery prices will rise further because it costs more to ship everything. And electricity tariffs, which have a 3-month lag to oil prices, will start reflecting this spike in Q2 and Q3. But what if Qatar's energy minister is right and oil eventually hits $150? That's when petrol goes past $3.50 per litre. Inflation pushes past 4%, and at that point, a recession would become almost impossible to avoid. Now, while all of this might sound scary, there are some valid counter-arguments as to why this time it might not be as bad as you might think. First, the US is now a net oil exporter. Unlike the 1970s, America produces more oil than it consumes. So the US economy is partially self-insulated from supply shocks. What this might mean is that a Strait of Hormuz closure today would hurt the US far less than it would have in the 1970s. Second, the US and other IEA member countries now hold about 1.5 million barrels in the strategic petroleum reserves that they can release to cushion supply shocks. For example, in 2022, Biden released 180 million barrels from the US reserve and oil dropped from $130 back to $80. So there's a release wealth that simply didn't exist in the 1970s. Third, central banks are much better at handling inflation today than they were in the 1970s. Back then, the Fed was too slow to raise rates, and inflation spiraled out of control for almost a decade. But in 2022, when inflation hit 9%, the Fed raised rates at the fastest pace in 40 years and managed to bring it back down without causing a recession. So what does all this mean for you? If you are a long-term investor, it's important to remember that every single oil shock in history has eventually recovered. 1990 recovered within 12 months. 2022 didn't even produce a recession. Even 2008 eventually recovered, though that took much longer because there was a housing and credit crisis that happened together with this oil spike. So the question isn't so much about whether the market will recover, but whether you can stay invested long enough to see it. And here's the part I think a lot of people are missing. Oil spikes can crush the broad markets, but not every company's earnings are actually affected by it. Take for example, tech companies like Apple, Microsoft and Nvidia. Their earnings come from software, cloud services and AI chips. Same with consumer staples like Procter & Gamble and Coca-Cola. People still buy toothpaste and drinks regardless of oil prices. Or payment networks like MasterCard and Visa, which take a cut of every transaction no matter what oil costs. So whether oil is at $115 or $150 a barrel, it doesn't change their revenue or their margins. And yet, their stock prices all drop along with everything else. What this means is that even when the entire market sells off on oil fear, strong companies whose earnings have nothing much to do with oil could be trading at a discount for no fundamental reason. And that gives you a very good opportunity to buy them at very attractive prices. And the historical pattern supports this. In 1990, during the Gulf War, and in 2022, during the Russia-Ukraine conflict, markets sold off hard. But when they recovered, the companies whose earnings were never actually impaired by oil actually recovered the fastest. But of course, if this oil shock drags on and actually triggers a recession, that's an entirely different story. Because in a recession, it's not just oil-exposed companies that will get hit. Earnings across the board will start falling. Consumer spending will drop, and the Fed is stuck between cutting rates to save the economy and keeping rates high to fight inflation. That's a stagflation scenario, and that's what made 1973 and 2008 so painful. But if you look at how the S&P 500 has actually performed around every US recession since the 1950s, something interesting stands out. Stocks actually perform worse in the year before a recession than during the recession itself. For example, the average return in the 12 months leading to a recession was negative 3%, while during the recession, it was only negative 1%. That's because the market prices in the pain before it even officially starts. As for the recovery, in the 12 months after a recession ended, the S&P 500 was positive 91% of the time, with an average return of 16%. And if you stretch that to 2 years, it goes up to a 20% average return. So even if you do end up in a recession, history says that the recovery is almost always worth the wait. Now, of course, this is just the worst case scenario, and whether we actually get there depends entirely on how long this conflict lasts and how quickly oil comes back down. But regardless, it's worth remembering that drawdowns in the markets are nothing new, especially during times like this. And if that alone makes you want to panic sell everything, you might want to rethink your investment strategy, because as the saying goes, no crying in the casino. If you zoom out, the S&P 500 has never delivered a negative return over any 20-year rolling period in its entire history, at least not yet. And yet, according to JP Morgan's Guide to the Markets, over the 20 years from 2002 to 2021, the S&P 500 returned 9.5% per year, but the average investor returned just 3.6%. That's less than half. And the reason? Panic selling during crashes and buying back in too late. That gap is the cause of emotional decision making. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe, as I'll be posting new videos every week.